All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Mark Kimbrough.
Hey, hey.
It's 10 a.m. Pacific time here on September 26th. It was an interesting week. I guess it's the start of fall now. It does feel like we're in a place where, even though it didn't feel like fall in downtown Los Angeles this week, it was a little warm. But we got fall. There's Ryder Cup this weekend. Seems like a good way to close out September.
Yeah, I recently learned a new term. We're in the Burr months. It's supposed to be. I know it's still a little warm a couple weeks ago, but yeah, we're entering that colder period now. So it is nice to get a little relief from the summer.
Yeah, hopefully we get a little bit of relief. 90 degrees is a little bit warm. But if let's look at this, shift gears over here to the stock market for the where are we for the week? S&P down, I call it 35 basis points or so on the week. Your big winner was energy up 5.5%. Utilities were up 2.5%. Real estate was up a quarter or 3/4%. Those were your only winner. Oh, tech. I showed tech up 3 basis points. So that's another winner. So we got four winners on the week. Your big loser looks like it was materials down 1.8% and consumer staples down 1.3. So about 35 basis points. And kind of it's going to be the theme for the week. Kind of a quiet week. Not much movement going on. The Russell 1000 was down 0.5%. Russell 2000 Russell 1000 was down 0.5%. Russell 2000 down almost 1%. Growth down 1.1. Value flat. And I show S&P equal weight eking out a positive 10 basis points here on the week-to-date basis. So pretty quiet week. Not much movement from the stock market side of things. Similar to the bond market there. I showed the 10-year up 6 basis points, the 2-year up 8 basis points. So a little bit of movement there up in rates. As you would expect, the ag's down a 1/4 point from that. Looks like investment grade corporate bonds, your worst performer, down almost 0.5%. With agency mortgages, your best performer. Kind of almost in line there with treasuries, both of them down around 20 basis points or so. If we go to your non-traditional sectors, high yield flat. Bank loans up 10 basis points, and EM, the big winner, up almost 0.5% on the week. If you kind of look at I was just looking at the 10-year changes every day. It's like Monday was up 2 basis points, Tuesday was down 4, Wednesday reverses Tuesday, so it was up 4, Thursday was up 2, and Friday's up 2. So you had that 6 basis point shift over the week, but it was like 2 basis points here, 4 basis points there. Pretty quiet week overall. Not much, as Mark will get into, not much macro data, really market moving macro data. Just kind of a calm, low volatility environment here.
Felt like a bit of a continuation from last week. We had the 10-year is up 16 bips from the day before last week's Fed meeting. So it was kind of the local lows in some of those rates, and it just kind of has a little continuation this week.
Yeah, and everyone was like, okay, let's focus on the Fed meeting. What's the Fed going to say? And then you kind of have just like a sigh of relief. Okay, let's just have a calm, nice, relaxing week until we get to next week, and next week should be interesting. But we'll get to that. Don't front run ourselves here. All right, commodities though up 2% on the week. Energy, as you would imagine, the big winner, up 3.6%. I guess precious metals up 4%. With gold actually only up 2.75%. We're looking at the 37.71 on spot gold as a time of recording. So up another almost 3%. Up 42% on total return basis for gold year to date. So pretty big move there after continuation of that big move. But WTI crude oil up 5.5%. We're at 65.87. We're kind of broken out of that. Well, we'll see if this holds. We were in that 60 to 65 range. We're at 65.87. So broken out maybe. We'll see if it holds here through the weekend and into next week there. But really that's it for commodities turning positive week. I guess the power of diversification. If you own some commodities, maybe you squeaked out, a kind of flat week for yourself.
Diversification works sometimes.
Yeah.
Still prefer it to not.
That's right. All right, Mark, why don't we get into the macro side? It was as I mentioned, pretty quiet week. No, I guess you have some kind of tier 1-ish data, but why don't we get into it?
Yeah, nothing like you said. The biggest data points came today, and not much market movement today. But our top 5 for the week, we got PCE data coming out today, also personal income and spending. On Thursday, we had the third estimate of Q2 GDP. Usually don't like to talk about the third estimates of things, but it's nice revision in there. We have the high frequency initial and continuing claims data coming on Thursday. And then lastly, S&P PMI data. So let me jump right in here. On Tuesday, we got the S&P the S&P PMI data. This is preliminary data for September. Everything came in expansion territory, all missing estimates, a little below the prior. But let's give you some numbers real quick. The manufacturing came in at 52.0. The services came in at 53.9, and the composite measure came in at 53.6. There's really 2 points I wanted to highlight from this report. One is, while we're at we're at a 3-month low right now on the composite measure. This is actually reflecting the strongest quarter we've seen so far this year. Within the S&P Global's report, they're indicating that what we've seen so far through Q3 is indicative of about a 2.2% annualized GDP rate. And actually interesting, today we got the Atlanta Fed's GDP Now update, and they came in at 3.9% versus about 10 days ago they had 3.3. But so interesting to see that GDP point, but the inflation numbers in there were, I thought, more important. They had a chart in there that showed the input and output prices for both manufacturers and service providers. And while the input prices are still showing the underlying inflationary pressure for both manufacturing and services, the output prices, what they're charging their customers, took a dip this month. All still in expansion territory, but the dip, the manufacturing looked to be the lowest almost all year, while the services was the lowest level maybe since early this summer. But all that's indicative of, just the little bit of margin pressure and maybe a little disinflationary help. So that was an interesting report. It's soft data, so we're just using that to kind of help us look at that along with the other hard data points that we prefer. Moving forward to Thursday, so the GDP for the third estimate of Q2. We got a sizable revision here. Like the advanced estimate 2 months ago was at 3%. We got a 3.3% revision last month, and now we're up to 3.8%. The bulk of this was personal consumption being revised up. It was revised up from 1.6% quarter over quarter annualized to 2.5%. That made up about 60 bips of the contribution. There's your 50 bip improvement. Goods offset it a little bit, but for the most part, it was almost all services consumption that improved. So nice to see that. There's another category in that report called final sales to private domestic purchasers. People have been talking about that more this year, given the volatility we've seen in the net export numbers and the change in inventories. This gives you more of a look through into the consumer and just private investment. And that was revised up to 2.9% quarter over quarter annualized from a prior of 1.9. So, I mean, not a lot of market movement coming out of this report, but it was a nice GDP report to see as we're heading into next month's Q3 report. Moving forward to Thursday, we got the high frequency labor data. We got the initial jobless claims for the week ending September 20th and the continuing claims for the week ending September 13th. Nice prints for both of them, relatively speaking, compared to what we've seen over the summer. You got 218K for initial claims. That was below estimates in the prior. It's the lowest print we've seen actually since middle of July this year. And it brought the 4-week moving average down to 238K. We got another one week of data to roll off that Texas print we had 3 weeks ago. It looks to be normalizing now. So 4-week moving average continues to settle down and hopefully dips once we have that print roll off. The continuing claims came through at 1.926 million. This was 6K below the estimates, 2K below the prior, and it's the lowest print we've seen since the week ending May 23rd this year. It's brought the 4-week moving average down to 1.93 million, also the lowest we've seen since the week ending June 6th. So nice to see some improvements there, maybe settling off a little of that summer seasonal that we've seen the last few years. That brings us to today. We got the two big reports. We got personal income and spending and the PCE. So we'll start with personal income for the month of August. Came through at a firm 0.4%. That was 0.1% above estimates, right in line with the prior. At a more precise level, it's 37 bips, right in line with the trailing 6-month average. I'm going to say that within the report, all in all, knee-jerk, it's a firm report. We saw a little bit of a slowdown in compensation growth, but I'll call that noise. It was offset by a rise in business owners' income and transfer seats. So all in all, just a firm income print. Looking at spending, came through at 0.6%, strongest we've seen since March this year at 0.8. That was driven by, a mixture of goods and services, actually. It was 0.8% month over month for goods, 0.53 month over month for services. And I'm going to give you some 6-month annualized rates, actually, because I think it's important for this data point. You got the headline is running at a 6-month annualized rate of 5.9%, the goods at 5.1, and the services at 6.2. So all in all, just seeing firm income and spending growth in this report. And lastly, brings us to PCE for the month of August. Everything came right in line with estimates. The headline accelerated a little bit from the prior, so we can run through some numbers. We got the headline month over month at 0.3%, the headline year over year at 2.7%. The core number came in at 0.2% month over month, and the year over year at 2.9%. Look, we actually got a deflationary core goods print this month that came in at 0.1%, negative 0.1%. Core services ticked up to 0.34%. You know what? Actually, I'm going to focus again on the 6-month moving average. I prefer that when you're looking at the high frequency data. You're trying to look at a higher frequency look at some of these longer data points. So I'm going to give you some stats here. We got the core number. It is down to 2.5% on a 6-month annualized rate. Core goods dipped below 1.1% versus it was up at 3% back in June. Core services is below 3% for the first time since January of 2021, while super core services, that's the core services less housing, that's below 2.7% for the first time since September 2020. So, I mean, it's to me, it's showing we still have the disinflationary trend in there, although I can give a fair nod and say over the past 3 months, you've seen services tick up a bit. Core is leveled out, but while goods has declined, services has picked back up. So we'll see how that continues to go now that we've started either the second leg of the Fed's cutting cycle or what if you want to call it a new cutting cycle. We'll see how this inflation data develops. And that wraps up the week. Like I said, not a lot of market moving stuff here, but some tier one data.
Yeah, and it seems like I guess PCE doesn't really move markets because it's kind of known. And really, when you think about it, when you look at it, it seems like things are, I guess, the negative core goods, and is the one kind of bright spot because you kind of need the good side to have the deflation because that services side doesn't really ever get that that low if we're going to get back to like a 2% core PCE. So it's kind of got a lot of that work's got to come from that good side of things.
Yeah, that's I was speaking to that in the last press conference, talking about, I mean, that's this normal state of things is deflationary for goods for us. So it's good to see that come back for 1 month. We'll see.
Or you just make the hedonic adjustments to make it come down.
Make it fit.
All right. Let's take a look at what the Fed funds probability is. We're looking at 88% probability of a Fed cut here on October 29th. So a little bit over a month from now. And we're looking at 1.65 cuts here by the end of the year. So it hasn't really moved too much. Obviously, a lot will depend on kind of what the data shows and if we get the data. So if we kind of look at the next week's data points, we have on Tuesday, we got JOLTS job openings. That'll be important. Estimate is 7.1 million. Prior was 7.18. So kind of expected to be flat there. We did get home prices come out also on Tuesday. And that's estimated to be down about 10 basis points or so. So kind of flat there. And then we have the big thing that we'll keep an eye on here is we have the potential government shutdown on October 1st. Seems like it's pretty likely that that's going to happen. And did see that there was some discussion about whether we're still going to get the jobs report on Friday, whether we're going to get any sort of data from the government. And historically, we haven't. So I think that if we look at it and say, based on historical precedent, we're going to go kind of fly blind here for a couple weeks, which may make the ADP employment data that comes out on Wednesday a little bit more important. We also get ISM manufacturing on Wednesday. Like these private party, maybe they're not tier one type data points, obviously increase in importance when you're not getting the tier one, the unemployment rate, the payroll data that you would get on Friday. We do get ISM services also on Friday. So those other data points that we're actually getting might become more important. And, maybe that's kind of why the market is kind of discounting maybe more of a September rate cut because they think the Fed might be flying blind for a month. I think last time we were in the shutdown was like 35 days. So do we get two payroll numbers on the same day? Do they just kind of aggregate it? It'll be interesting to see. But that's kind of where we stand here for the next week. Could be important, could be nothing. I guess that's kind of the way things have been going kind of cuspy here recently.
Hopefully we get the data.
Yeah, I mean, at least it's something that you can feel a little bit more comfort one way or the other on term where the economy is going. But with it, I think that wraps it up for this week.
Yes, thanks to our listeners out there today on DL Minutes. Hit us up on X at DLine Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Don't forget our YouTube channel is youtube.com/DoubleLine Capital. We have Bill Campbell's TV appearance on Bloomberg TV from earlier in the week. He was talking about fiscal pressures, which obviously is very important these days, and emerging markets bonds. So thanks for tuning in. I hope everyone has a great weekend.
Yeah, thanks everyone. Stay safe out there.